Adjusting entries for revenues. When recording journal entries, the generally accepted accounting principles require accountants to use the accrual basis of accounting over the cash basis. This involves recording revenues and expenses as they actually occur instead of when the cash transaction happens. For example, under the accrual basis, a lawn mowing business would record a revenue in the general journal when a client's lawn is mowed, regardless of when cash payment is received from that client for that service. Now, because the exchange of cash won't always coincide with the earning of a revenue, accountants must use adjusting journal entries to ensure that they are properly recorded and that cash transactions are matched up with the right period. So to define adjusting journal entries for revenues would be entries made in the general journal at the end of each accounting period to record revenues that have been earned but not recorded. They are necessary because they ensure compliance with the revenue recognition and matching principles, and they help businesses gain a better understanding of their actual revenue and financial position. There are two types of basic scenarios where adjusting journal entries for revenues are made, and they are deferred revenues and accrued revenues. Deferred revenues often occur when a business receives prepayment from a customer before a good or service is provided. An example of this would be if Netflix sold a 12-month membership subscription to a customer in January for $120. To record this, Netflix would initially debit $120 cash and credit $120 to a liability account for their January statement. Then, Netflix would use adjusting journal entries to increase their revenue account and decrease their liability account, both by $10. Which is calculated by dividing $120 by 12 months each month, assuming financial statements are prepared at the end of each month. Accrued revenues is basically another name for a receivable, which is when a business earns a revenue but isn't paid until a later date. An example of this would include a law firm that provides a service to a client and bills them $1,000 in January, but only receives payment next month in February. This would be recorded by first increasing their accounts receivables by debiting $1,000, as well as increasing their service revenue account by crediting $1,000 for the month of January. And then, after the firm receives payment in February, to adjust, they would increase their cash account by debiting the $1,000 and subsequently reduce the accounts receivables by crediting that much also. Thank you for watching my video about adjusting journal entries for revenues. I hope you have learned a lot more.